But essentially, we're going to talk about macro environment, what's going on in the economy today, what's affecting the real estate market, what we should be paying attention to versus what the media kind of clouds our judgment with, potentially. Okay. Then we'll talk micro, more GTA, get into Brooklyn, Whitby, growth specifically, what affects pricing here, what our outlook is, do our best to predict the future based on what we know today. And then we'll get into a couple opportunities in Brooklyn specifically and chat about all these signs you see riddled all over the roads and what's coming. One of the big things that I love about this community here is that it's attracting the right developers. You're not seeing ABC and Co. You're seeing the Mintos, you're seeing the Treasure Hills, you're seeing the Madisons, you're seeing the Zancors, which is a testament to the value they attribute to this pocket, this location, and the potential future growth. Okay? You've got something on your seat. You might have sat on it. You might be holding it. Inside is a copy of the slides. There's a pen in there as well. If you want to take notes on some of the economic things as we go, feel free. If you want to follow along, if it's easier to comprehend, by all means. Otherwise, we'll get into it. So just so you know a little bit about me and why maybe some of what I say has some merit. I'm the 18th ranked agent in the country, myself and my team included, in all of Canada. We transact a lot, we transact often. That's a testament to what we do from a customer service perspective, repeat business and the like. Top 35 under 35 in the country 4 consecutive years. We do a ton of business throughout Ontario, over $1 billion sold in our short careers so far. We've got a team of over 30 agents. Some of them are here today, so if you have questions, I'm sure they'll make themselves known. I've taught university programs, I've taught customer service, I've taught professional selling, I've taught real estate economics at York University and Guelph University. I've also taught at Humber College, so I really love to teach and coach and share my ideas. I've got my master's degree from Schulich School of Business, specifically in real estate and infrastructure, so kind of painting a picture and predicting what's to come to the best of our ability. And we've been featured in a ton of international publications: Forbes, Business Insider, CEO Weekly, Toronto Star, Globe and Mail, Washington Post, LA Weekly, a few of those. So a lot of what we say is heard around the world, and we're really excited to just bring you a little taste of what it is that we do. All good? All right, cheers, let's get into it. So first things first, we got to talk about the elephant in the room, okay? Whenever we're talking about the economy, we got to talk about the elephant in the room. It's this gentleman with some funky hair south of the border, Donald Trump. The one big thing affecting the market more than anything right now is him. I'll tell you this, tariffs are here to stay. They're not going anywhere. They're generating way too much money for the US economy, and whether it's this president or the next one, they're not going to eliminate tariffs. They're just generating too much income. Okay, so what can we take from that? Well, we have to learn how to live with them. We have to learn how to manage tariffs and work with them, live with them. We're doing that. Biggest effect this is having on Canadians is the mentality, is up here. The lack of confidence in what's to come, the lack of predictability. If we have predictability, we can make educated decisions. If we can't predict what's going to happen, then we have an inability to make an educated decision. And real estate, housing, big decisions require a sense of confidence or a feeling of a confident outlook, which unfortunately he's tampering with. Now, it's not just the elephant in the room. There's a lot of elephants in the room, if you will, and that's the fundamentals of our real estate market. For a long time, it was inflation running rampant post-pandemic. The value of a dollar was just being eroded, just like that. Money was cheap for a while, then money got expensive. Canadians stopped spending money, started stockpiling. So we're going to cover a lot of what those elephants are today as we go. Okay, what's actually impacting our market. So I'm going to take you on a bit of a timeline. We're going to talk about how we arrived here from a market perspective, how we got to where we are, why the market is what it is. We'll talk about what here is, kind of what we're dealing with today, where we go from here, so a bit of an outlook, and then what the opportunity is today for investors, upsizers, downsizers, and what have you. All right? There we go. So essentially, we're all familiar with the pandemic. What did the pandemic do from an economy perspective? Well, cheap money, okay? When money is cheap, almost free, it accelerates existing trends. So it's not that the pandemic inspired any kind of different behavior or impacted the market any differently than it should have, but it accelerated existing trends. Okay, so what we saw was about 30% on average growth throughout the GTA real estate market in about a 2-year span. And when you look at a 40-year moving average, the average growth in the GTA has been 5% year over year over the past 40 years. So ultimately what we saw was 6 years of growth in about 18 months. It's unsustainable. We know this, okay? And what happened was it led to aggressive rate cuts. Money was free. When you get cheap money, what happens? People borrow, and you stop spending your own dollars. You start spending the bank's dollars. You start spending your borrowed funds, because why wouldn't you? So when you're investing or spending money that's not yours, that's ultimately free, you tend to spend more of it, right? Remember in your birthday card, your grandfather would give you $50. It was a lot easier to spend than when you had to go cut 4 lawns or shovel 10 driveways to make that $50. It's a lot easier to spend that found money, the easy money. And money was easy to come by. And because of high consumer spending, inflation went crazy. That was a problem. Bank of Canada had to do something about it. Bank of Canada, post-pandemic, decided to hike rates aggressively. We know this. We've all been exposed to it. If you have a mortgage, you know. Okay, if you carry any kind of debt, you know. And the only tool we have to combat crazy inflation is to make money more expensive. So you hike rates pretty quickly, pretty aggressively. Okay, and when you pay attention to the trends, to the numbers, to the stats, it gives you this ability to make predictions. The problem with the pandemic was it was hard to tell. It was hard to judge. The government told us we're not changing rates for 2 years. All of a sudden, 9 months later, let's start hiking rates. So that's where, as a consumer, as a housing buyer, seller, we started to lose confidence in predictability, if that makes sense. And that's a lot of what led to this lull we're seeing today. What happened in that market was a lot of investors in general, home buyers as well, we ignored the fundamentals. Home buyers in general, in any market, we've worked in a lot of markets, and generally, I don't want to be on a main road. I don't want to have hydro wires in my backyard. There's certain things that impact value. There's certain things we put into an investment prospectus in terms of what does the post-secondary education look like in a particular community? What does the level of education look like? What does the rental pool look like? What's the future growth? Where's the infrastructure going? Right? We look at a lot of these numbers. During the pandemic, it was just as crazy as crypto or NFTs. Remember those? Let's buy an online photo for 40 grand. Like, come on. But when everyone's doing it, it seems to make sense. Didn't you used to tell me if Sally jumped off a cliff, would you jump off a cliff? Well, the answer was generally no, right? No, I'm not going to do something silly if someone else does it. But during the pandemic, we did, because it was so easy to do it. Everyone else was doing it, so we did it. We lost sight of the fundamentals. So I want to bring back what those fundamentals are and why we are here. Let's talk about here. Well, you know where we are here. We're at the Legion in Brooklyn, in Whitby. This is here. But from a market perspective, I want to get into where we are today. And one of the big things that we've seen is the lack of housing starts. This is wild to me. This one just blows my mind. Because all we've ever talked about in the Canadian housing market crisis, affordability, this and that, we've got to build more homes. We've got to build more homes. A lot of the policy, from the politician standpoint, a lot of the policy change and shift tried to curb demand. Foreign buyer ban, higher taxes on investment properties. They tried to limit the demand. It's an impossibility. You cannot satisfy the demand in, I'll call it, not the Canadian housing market, but the GTA housing market. There is no such thing as a Canadian housing market. We are so unique in Toronto and Vancouver compared to Yellowknife and Georgetown, if you will. Okay? But when I speak to housing starts, 16% we slid just in August. Developers aren't developing. No one is deploying capital in this market, nor have they for the last 3 years. So this excess inventory that's being talked about in the market, on the news, BNN, this and that, when they interview us, and they say, what's going on? We're oversupplied. How can we talk about a lack of building? If I was to purchase a gas station downtown at, call it Yonge and Bloor, and I buy the gas station on the corner for redevelopment potential, any guesses how long it would take for Vanessa to walk into her brand new condo unit from start to finish? I buy the land, I'm a developer, I want to go from A to Z. By the time it's finished and my buyer's moving into her new unit, any guesses on how long that takes? 5 years. 5 years? Anyone else?
8 years.
8 years? Anyone else? 7? Anyone else? 9. Yeah, okay, so all around the ballpark, 5 to 8. 7 years. 7 years. So we haven't put shovels in the ground for 3 years because of this volatility, this unknown, if you will. And when developers are already making razor-thin margins, and I'm talking like 7 to 9% on an average high-rise in Toronto, when you sprinkle in just an ounce of uncertainty or volatility or risk, it's not worth it. Okay? The juice isn't worth the squeeze, if you will. we're seeing a huge backlog of what should be new supply to the market, just non-existent. So if you fast forward 2027, 2028, 2029, where are they going to live? Where are people going to live? I don't know, because we're not building anything. Now, single-family building permits, this is more relevant to us in our market where we are in Whitby, not so much the high-rise, but single-family building permits. This is low-rise. This is your townhomes, semis, and detached homes, okay? We're not building them. We don't have land to build them on. When developers do find a potential opportunity, it's highest and best use. It's high-rise, it's multifamily, maybe purpose-built rental, which is something I can touch on later if we get to it, but it's a Band-Aid that's going to fall off next time you go in the shower. It's not a fix to the market, okay? But ultimately, decade-long lows in the single-family building sector. During the pandemic, we saw massive outflows from the core. Why? Because the amenities shut down. You couldn't go to the bar after work. You couldn't walk to a Leaf game. You definitely couldn't go to a Jays game. You couldn't do anything fun. The reason for paying a premium to be in the downtown core, in what we live in, a concentric city model, evaporated. So the value of these periphery markets, Brantford, Collingwood, Peterborough, moving outward, went nuts. We've since corrected. So a lot of developers, I'll call them new entrants to the market, new developers, inexperienced developers, they couldn't afford to maintain the land. Rates went higher. They couldn't afford the cost to build. They lost money. You've probably heard a lot of canceled projects, not from AAA developers, from your BCD all the way to Z developers. Everyone and their cousin thought they could develop property when it was rainbows and butterflies. Unfortunately, now that's not the case. So canceled projects, combined with a lack of available land and a reverse trend of expansion and urban sprawl, moving back into the core, moving back to where the amenities are, moving back to where the infrastructure is, the education, the jobs, the value of that periphery land has gone down. And there's no incentive to build because the resale market just isn't there to make it worth their while. Okay? And this is a big one. If we're not building single-family homes, then what the heck? Because where is everyone going to live? We added 1.2 million people to Canada last year. In 2023, it was 1.5 million people. That's insane and unsustainable, and we know we've reduced. We've reduced in 2025 and put caps on it going forward, and it is what it is. We need immigration to sustain our economy, but this level of immigration was incredible. The country needed to add 500,000 homes to its housing supply in 2024 just to keep up with demand. We only added 250,000. We only added half of what we needed. Developers were de-incentivized, taxes on new construction were way too high, and the resale values were just not there. It evaporated post-pandemic. This is the definition of a black swan event, if you ever studied law, okay? So basically what we're seeing is a massive disconnect between fundamental economics, supply and demand. When you have more demand than supply, what does that generally do to prices? There's 3 people that want to buy a brand new Civic, but there's only 1 for sale. It's probably going to sell for a pretty penny. Everyone's going to outbid one another and get it up to a point where it sells for more than it should. Okay? That's ultimately what we're seeing. So where do we go from here? What's our heading? Where are we going? What happens now? We know where we've come from. We know where we are. Where do we go? So let's talk about where we go from here. We know rates are anticipated to fall even more than they have already. Okay, very, very confident we're going to see at least 1 more rate cut before the end of the year. There's going to be 2 more announcements. Very confident. Economists agree. We'll see at least 1 more. Some are thinking 2. I'm more in the camp that we're going to see at least 1, phase into it, and very, very likely 1 in the first quarter of 2026. That being said, what does that do? It makes money cheaper. When money's cheaper, we can borrow more. Not as cheap as it was during the peak of the pandemic, but getting back to that fundamental, appropriate, predictable number where decisions can be made and action can be taken. Okay? All that you guys have all this in your booklet, so I don't want to keep you here. I want you to keep drinking and eating and stuff. So I'm going to go fast, but if you want to take notes and follow along, by all means. So what are our immigration targets for 25 through 27? Well, they're less. Okay, we're reducing them closer to the 350 range. Purposefully. Just because we've reduced the number of immigrants that we're looking to bring into this country, which need housing, doesn't necessarily mean that the demand for housing will reduce. We have a backlog. If just last year we only built half of what we needed to get back to what economists would call a balanced market, we still have a lot of ground to make up. We've still got a lot of people that are stuck in terms of where they live. Undesirable locations, renting when they'd like to purchase, maybe they're priced out of the market, maybe it's a qualification issue. Maybe they just simply can't get qualified. Okay? So although we are reducing our immigration numbers, they still strongly surpass what we're building in annual new roofs, new doors, if you will. Okay? Now, I will tell you that the quality of the immigration today, tomorrow, and in 2027 is going to be a lot more significant than what we saw in 23 and 24. I'll get into that and why, but I want to quiz you first. So this is a true stat that 52% of immigrants are coming to Canada from one specific country. I want you to raise your hand if you think it's the one I'm going to read out. If you think 52% of immigrants coming to Canada so far in 2025 are coming from India, raise your hand. India. Okay. Anyone think China? One? Okay. Anyone think Canada? Couple? Okay, that's a funny guess. United States of America? Anyone? No? How about the Philippines? You think Philippines? Okay, well, let's see. The correct answer is Canada. 52% of the immigrants in 2025 are coming from Canada. They're already here. They're already here on student visas. They're getting educated, they're working, they're getting permanent jobs, and they are single. The important thing to understand about the 52% of Canadian immigrants immigrating to Canada is that they're educated and they're single. So when we go back to 2023 and 2024 and we look at those 1.2 and 1.5 million bodies, we've got to understand that so-and-so was coming from India or China, and they were coming over, getting a job, working, and then sponsoring their partner and their 2 or 3 kids. That's one income earner contributing to GDP and one homeowner or renter contributing to the housing market with other bodies living in that space. Why this is such an interesting stat to me and why it makes me extremely bullish on the future of Toronto and GTA real estate is because when you've got educated, higher income earners that are single, each one of those numbers is a homeowner or potential tenant or potential renter, contributing to the economy, contributing to our housing market. So the quality of that 350 is a lot more significant than the former of the 1.2, 1.5. And it's just data 101. When you take a little deeper dive, when you look a little deeper at the numbers and try to understand why, it starts to make a little more sense. So when your friends start saying, oh, you go to hockey, you get a beer after hockey, or you're playing darts at the Legion, and you say, oh, this real estate market, right? Everyone loves talking about real estate. Oh, this real estate, it's crazy, isn't it? Yeah, my neighbor's house just sold for crazy money in 2027. Why? I don't know. Well, you'll be able to say why. Because the demand makes sense. Where the demand is coming from is defended, if you will, okay? Now, just in September, we added 60,000 jobs, far surpassing the expectations of 15,000. Our unemployment rate, huge surprise, just last week, held steady at 7.1% unemployment. And why this is important or relevant is because when you look at any recession ever throughout history, double-digit unemployment. People didn't have their jobs. That's why they couldn't afford to pay their debt. That's why we went into recession. We were never actually in a formal technical recession. Technical recession means 2 consecutive quarters of negative GDP. We never hit that. We never did. And to maintain that level of resiliency is a testament to what we have here in the GTA. Okay? Now, what's interesting is the market response to this big surprise in the jobs market is that the bond market's barely reacted. Okay? The 5-year yields rose just 5 basis points, and that's interesting. Basically, what they're telling us, or what the markets are factoring in, is other things. So we've got to explore those other things. What are those other things? The weakness between the headlines ultimately is that a lot of the job growth initially coming out of the pandemic, the false narrative, if you will, road to recovery. Anyone else see this big fly over here? If anyone gets a chance, just grab them. But it was public sector driven growth. When government adds jobs, it gives this falsity to employment. What's really, really cool about right now is we're seeing the private sector and we're seeing self-employed persons really contribute to that employment rate. The last 2 months consecutively, Public sector was even keel. It was the private sector and the self-employed sector that was driving employment. That, to me, big positive. Some of the numbers is that Alberta was carrying the load, okay? And when I speak about there's no such thing as a Canadian housing market, anyone familiar with Benjamin Tall? Probably one of the most famous economists to ever be, really. Great guy. He was just meeting with Mark Carney in Ottawa, and he was the one that said there's no such thing as a Canadian real estate market. We have these submarkets, okay? Alberta carried a big part of that load. Alberta was 75% of the Canadian jobs increase. We're bringing back a lot of oil sector. We're bringing back, well, not bringing back, but we're finding new ways to create a more diverse economy in Alberta. If anyone's curious about Alberta, we sell a lot in Edmonton and Calgary as well, multifamily. If you have questions on that, happy to talk about it. But that's just something to kind of look between the lines and see, well, what are these Canadian stats really adding up to? Okay, and a big one that's interesting to me is the fewer hours worked. I don't know what it is, but coming out of this pandemic, people seem to be moving a little slower, not being as aggressive, waiting for a reason to do more. The number of hours worked actually declined. This is a reason for me to consider the inverse now, where, well, maybe there's a reason to think those unemployment numbers are a little lower or higher than they should be. I think that the unemployment numbers could be a little bit better if the working population was to work a little more, spend a little more hours at work. We choose not to because we're just kind of waiting for things to happen, right? And what I take away from digging deep and going into the details of the data is that we're elongating this opportunity to get into the market. We know the fundamentals are strong. We know the right things are cooking. We know it's coming. If I was to say to you today, guess what I'm making, okay? I'm going to describe a dish. Anyone a chef? Me neither, but I'll do my best. I take some dough, I get it at Longo's, I knead the dough, I put it out into a nice circle, put some tomato sauce on there, slap some pepperonis in there, put the oven at 475 degrees, maybe, and I put it in the oven. What did I just create? Pizza. Yeah, it's pretty clear to see, yeah? I made a pizza. I didn't have to tell you I'm making a pizza. When I told you the ingredients, you were able to decipher what's coming out of the oven. It's the exact same thing here. When I tell you the ingredients that are affecting the market today, it should be a pretty confident outlook that we are looking good. The worst is behind us. We have our jobs. We're confident in the economy. We're confident in the, call it economic outlook. We've got a pretty stable political environment. Some of the best post-secondary institutions in the world. We're attracting some of the top companies to come and set up shop here. Google's head office, Amazon's head office, Meta's head office, to name a few. Why do they want to be here? Why do they want to be in the GTA? For good reason, number of reasons. Now, this is another one when we dig a little bit deeper. The market balance, meaning supply and demand balance, it's tightening most in the metros, okay? So new sales to listings ratio, this is on the resale front, has improved in all of Ontario and BC metros, okay? So we talk about Alberta being a hotter market maybe now. If you're reading the news, Quebec's real estate market has emerged from the pandemic quite successfully. But not for a second would I say, let's go deploy some capital in Quebec. When you look at the metros, meaning the cities, the cores, the nodes, if you will, the only ones that are in a great position is the GTA and the Greater Vancouver area. What does that tell you? It tells you that we're getting back to that concentric city model. Concentric city model is where you have a nucleus of the working district and you work your way out. And as you work your way out from the nucleus, the trade-off between distance to the core and time it takes to get there is shown and reflected in real estate prices. The interesting thing about Toronto is that it's been the inverse for the last 12 to 15 years. The periphery markets, the suburban markets, have amplified at a quicker rate than the downtown core, which is very interesting. What we're seeing now is we're going to see the downtown core appreciate a little bit more rapidly with a few nodes following suit. You need a nucleus. I'm going to say that Brooklyn is that nucleus. We are in that nucleus. We have a reason to have jobs here, growth here, a reason to be here, transit infrastructure, investment from the municipal, provincial, and federal level. It's all happening. So this, to me, is another reason to be excited about what's coming in our particular market. Now, affordability is something that's talked about a lot, right? Okay, Ty, I buy something. What's my exit strategy? Okay, as an investor, for example, just put your investment hat on, or even if you're in real estate, your primary residence, what's your exit? Am I going to make money when I sell? Am I going to retain my hard-earned money, my capital, in this significant asset? Well, this is where we need to consider who's buying what we're buying today to sell tomorrow, who's going to be buying it then. What we're seeing now is an emergence of the first-time buyer coming back to the market. They were on the sidelines for 4 years. They didn't exist for 4 years. They're back. Why? Because affordability is improving. Interest rates are working their way down. There's some government incentives, CMHC, if you're familiar with CMHC, they insure mortgages, but they federally run initiative, if you will, but they've elongated the length of time you can have an insured mortgage, less money down on higher priced assets. So from a federal level, combined with monetary policy, we are more affordable for the average consumer. Our market is becoming more affordable. Also prices, I mean, we're still about 20% down from the peak of the pandemic. Household net worth, we hit a new record. Household savings are even higher today than they were at the peak of the pandemic. So picture that. You can't go anywhere, you can't do anything, you're working from home, making the same salary you're making, but you can't drive, so you're not buying gas. You can't go to the bar and buy a beer. You can't go to a Leaf game. You can't go shopping. So you can't spend your money that you're making. So household savings naturally during the pandemic went through the roof. Set a record then. Today, we have more household savings than we had then. That's why when the media talks about our GDP very stagnant and the US economy doing better, it was for a minute, but we were very stagnant post-pandemic, it's because we're stockpiling our cash. And we do this. When you zoom out, you look at a population, what we do when we have uncertainty in an economy or uncertainty in a market is we just sit tight. We just wait, right? It's like if you're in Kentucky or I don't know where they have tornadoes. Where was Dorothy from, right? And she locks herself in the basement and hides down there and waits for the tornado to go by. That's what we're doing. Where? Oklahoma. Oklahoma, sure. So you're in Oklahoma and you're waiting for the storm to pass. It's the same thing. Canadians are hiding in their bunkers waiting for the storm to pass because we don't know what's coming. We should be able to tell when we dive deep into the data, but there's a lot going on. There's a lot of clouded judgment. I get it. My mechanic the other day was telling me about inflation. And I'm like, when has a mechanic ever spoken about inflation? But hey, in this day and age, in this housing market, it's a relevant thing. It's a fundamental. It's affecting everybody. Okay? But this to me is another reason to be confident in the, again, resiliency of our market. I've already talked about this, that there's no such thing as a Canadian housing market. When you break it down regionally, everything's doing wonky things. Quebec, for some reason, has been the best performer from a Canadian perspective. I can't give you a rhyme or reason as to why, but I will tell you that they weren't hit nearly as hard at the onset of the pandemic. They were pretty level the whole time. So they're following consistent, fundamental real estate factors, which everyone else, especially the metros, are more subject to, if you will. So we experience the effects more harshly. But in a market like Quebec, where it's always pretty even keel, sure, they're doing fine. But this is interesting to me that there is no Canadian housing market. So when you hear these Canadian stats, I never read a Canadian stat because it's irrelevant to me. I'm looking at GTA stats, I'm looking at Ontario stats, specific, because that's what affects our market here, for the most part. Now, where are the buyers going to come from? Where's the action going to come from? We've had 4 years. I was talking to someone earlier when we were mingling. The biggest thing, the uniqueness of this market is that it's lasted for so long, this downturn or this lull. We're at the point now where there's this pent-up desire to do something. Having babies, getting married, graduating, moving out from your parents' home. 4 years is a long time. You've adopted a dog, you met a guy, you met a girl. It's time to move out. It's time to make something happen. Despite the market factors, we're fed up. We're not waiting for the flashing green light anymore. We're starting to see signs of that. In the GTA, we've seen now 5 consecutive months, month over month, of transaction volume improvement. And to see price appreciation, you need transaction volume. Consider your own home for a moment. Consider your own home. Consider that your neighbor just sells for $1.5 million. Your neighbor sold for $1.5. You call me, you say, Ty, I want to put my home on the market for $2.5. What would I say? You're nuts. right? You're nuts. No thanks. Call someone else. But when transaction volume is evident and your neighbor sells for 1.5, buddy on the other side sells for 1.75, someone across the street sells for 2.1, someone else down the street sells for 2.25, we're getting there. We're working our way up to 2.5. That's why we need transaction volume. And that's how transaction volume contributes to price appreciation. When we see transaction volume happen, it's kind of a, oh, here it comes, right? You know, if you're outside playing with the dog, playing with the kids, you're at soccer practice, it starts to really cool off. Feels like rain, right? Like, you know that feeling? It's the same thing. That's the feeling, that overwhelming feeling that, okay, we're paying attention to this increase in transaction volume. We know price appreciation is on its way. Now, it's real estate. We're not talking about anything else. We're not talking about a consumer product here. And that's a whole other story. Retail margins are crazy right now. You don't even want to know that if you just bought a new jacket or something. Oof, retail margins are nuts. That's a story for another day. But we're not selling consumer product. We're selling housing. So when we're selling housing, when we're selling something so significant, big ships move slow. So it's not that all of a sudden we have these new fundamentals and all of a sudden the Bank of Canada says, we're cutting rates by a quarter point. We're cutting rates by 25 basis points. Oh, everyone comes running to your open house. That's not the way it works. We have to accept that the outlook, the total outlook, the big picture, the long-term narrative has shifted and that trend will ultimately continue. We're not there yet, but it's coming. So GTA housing prices, basically, GTA specifically, over the last 10 years, we've seen about 7% appreciation. So ultimately, every 10 years, we're seeing a doubling in housing prices. This is including the pandemic and the post-pandemic. This is including that drop we've seen in the last 2.5, 3.5 years. Based on stats, based on data, GTA housing prices double every 10 years. That's wild. That's wild. Housing, your principal residence, was never meant to be an investment. It was never thought of that way, only until recently. Because of the way our market's gone, because we are so behind in building, because we cannot keep up with the demand. It's just wild to me. So why should you care? Why does it matter in Brooklyn? Well, we talked about low-rise, and Brooklyn has a lot of opportunity for low-rise right now. We're seeing it all over, right? I talked about all the signs we see on the downtown strip in Brooklyn. They're everywhere. What I like about it is it's the AAA developers. It's the right developers that are here, that are entering our market. But Brooklyn specifically should be able to see some pretty significant price appreciation in our housing. Why? We have to consider the profile. I coach sales as well. I coach sales, I teach sales. And one of the big things that we talk about is creating a sense of limit, or there's only so many of something, scarcity, if you will, okay? Creating scarcity. It's not necessarily that I can artificially create scarcity, but I can identify it. So Toronto right now, for the sake of the example, Toronto has 25,000 condos available for sale. 25,000. So someone calls me and says, Ty, I want to buy a condo in Toronto. There's so many of them. Let's just throw in a bunch of lowballs. Well, hang on. What are we looking for? I had a client the other day wanted something with a lake view in Queens Quay and wanted a view of the lake, one bedroom with a parking spot. Do you know how many one bedrooms, which usually the lake views are bigger units, lake view one bedrooms, and one bedrooms downtown don't have parking anymore. One bedroom lake view with a parking spot condos that were for sale downtown right now of those 25,000. Any guesses?
5.
Anything else?
2. 25.
Anyone else?
None.
2. There was 2. There was 2. So I'm not artificially creating scarcity, but when you want something specific, the scarcity exists. Similar to when I talk about this Canadian housing market, it doesn't exist. If you allow your judgment and your decisions to be made based on irrelevant statistics, you're not going to make educated decisions. You're not going to be making money in this market where opportunity is just screaming at us. And to Brooklyn, specifically, there is a specific profile of buyer that wants to be here. We're seeing a massive flow from North York, massive flow from Pickering, Ajax, and Whitby. We're seeing an incredible desire to be in a suburban community that offers a combination of, call it suburbia and connection to downtown. It's easy to get there. I go 3 times a week, maybe 4 times a week. It's 40 minutes, no traffic. There's also the opportunity to take a GO to no traffic. No traffic. That's the key. There's the GO train. There's transit infrastructure. We have the ability to work from home nowadays if we want to, some of us, right? So a community like Brooklyn is seeing a big attraction by specific profiles, young families, upsizers, and that's a lot of the assets that are here. So I talked earlier about a concentric city model, that nucleus. This is downtown Toronto. This is that nucleus, okay? And as we work outward from that nucleus, we start to see prices get cheaper, and we start to see that trade-off between my 40 to an hour and a half commute be reflected in the price of the assets. Not always, but in most cases, this is what should be reflected in Toronto. The cool thing about Brooklyn today is that when you run the numbers and you look at it, the numbers make sense. The trade-off between a detached or a townhome in Brooklyn for the distance we are to the core, it's one of the most attractive pockets in all of the GTA or beyond where those numbers are actually negative. Most other pockets, you look at a Vaughan, you look at an Etobicoke, an Oakville, an Oshawa, an Ajax, a Pickering, a Bowmanville, those numbers are in the pluses when you look at the actual numbers of the trade-off distance to time to commute to the core. Brooklyn is the only one, other than Peterborough, but it's a little too far. I didn't include it in my core numbers. It's the only one where the actual price of the asset makes sense based on a concentric city model. Wild. The prices are just, it's an opportunity to get in or move up or invest. Now, I want you to look at this one. It's the population density trends. Prior to the pandemic, and a big portion of my master's degree, we studied density. Density. Ontario took the most immigrants in 2024. Obviously, we don't have the total stats for 2025 yet, but over 200,000, okay? Nunavut had 56 immigrants arrive. Crazy example, crazy, wild example. But when you consider those numbers and you consider population density, where those immigrants are coming, where they want to be, they don't want to be in Nunavut, obviously. But to an immigrant coming from another country, they want to be in a multicultural environment. Toronto and Vancouver are your only options. Montreal, the language barrier, they're not going to go to Quebec. They're not going. That's part of the reason why Quebec's accelerated in a immigration halt, if you will. But when you consider population density, it's how many people live per square kilometer, per square mile. Population density in Brooklyn has a very aggressive plan to amplify. So you're not going to see smaller homes, but you're going to see more dense communities, which is what we're seeing now. Stacked townhomes by the gas station at the highway. You're seeing a big townhome development where the concrete plant was, Treasure Hill. You're seeing a lot of that dense build. And it's not only that the density is the trend, but it's also because developers want the highest and best use. If someone today said, hey, Ty, here's 10 acres of land. What do you want to build? Well, 10 out of 10 of you would say, well, I want to make the most money. I want to put the best stuff, the biggest stuff, tallest high rises, and then make the most bang for my buck, get the biggest return. One of the cool things about Brooklyn, not in all of the pockets, but in anything, I'll say north of where we are, they're not enabling insane density. And that does two things. One, it ensures a better quality of life for the end user, more space, places to play. But also it gives you that sense of scarcity because there's not many other communities or pockets within an hour from Toronto where they're saying, we don't want condos, we don't want stacked townhomes, we don't want this. We're okay with a little sprawl, and we're going to keep it that way. So the developers have to amend to that. The land prices are a little bit more affordable, and they're building a better quality asset. So when I speak again to that scarcity, you look at the Vaughns, it's the high rises. You look at the Markhams, it's the high rises. Unionville, right? Everything is going this way. You look at a Brooklyn, we're going this way, which again speaks to that scarcity and speaks to the profile of buyer or the desire of that profile of the buyer, what they want. Not everybody wants to be in a condo. I was at a huge Brookfield economic update the other day. Brookfield, Bruce Flatt was speaking. And essentially what he said is condo developers need to shift their idea of what they're building. And I agree in theory, because there's only so many young single professionals working in the finance district that want to live in 400 square feet. He says we got to start building bigger units for downsizers, retirees, families. Sounds great, sure. Don't have to cut grass, don't have to shovel snow. Sure, makes sense in theory, but developers can't afford to do that. Here's another one for you. Any guesses if I gifted you a plot of land downtown Toronto for a high-rise? Okay, here you go. Take it. Can you guess how much it would cost for me, without the land cost included, to build a finished product per square foot? My developer cost per square foot to build today. Any guesses? Anything at all? No wrong answers. Just curious.
1,000 a square foot.
Oh, wow, you nailed it. Yeah, it is $1,000 a square foot. $1,000 a square foot before land cost. That's carrying cost, that's loan cost, that's hard cost, soft cost, labor, taxes. $1,000 a square foot. If that's the imagine Apple. Imagine Apple cost them, I think someone told me once, cost them like $9 to make your phone. How does that make you feel? It's like $9 to make an Apple phone, an iPhone. But they sell it for whatever they sell them for now, $1,000. Just imagine their cost went to $1,500. Just imagine, to make that iPhone. How long do you think they could keep selling it for $1,000 at? What are they going to do? They're either going to cease the production completely, not possible, or they're going to increase the price to $2,000 per iPhone. They need to make a spread. Developers can't make a spread. They're not building. It's wild. So let's talk about Whitby's population boom. Why do people like Whitby specifically? Well, the overall population is projected to grow 190 to 193,000 by 2031, making it one of the fastest growing municipalities in all of Ontario. Why? Because of a lot of the fundamentals I spoke about. Because of the buyer profiles, because of what the consumer wants. Remember I talked about during the pandemic, money was cheap and we lost sight of fundamentals? We do a pretty deep dive whenever we're working with investors in terms of where you want to be and why you want to be there. During the pandemic, oh, my cousin bought in Barrie. I'm going to buy in the same building. Well, why? I don't know. He said it was a good investment. Okay, well, tell me about post-secondary. Tell me about employment. Tell me about transit. Tell me about the rental profile. Tell me about the disposable income. Tell me about the factors that make up a good investment. Oh, no, it's going to make money. I'm going to assign it. I'm going to make 100 grand. Okay, we lost sight of the fundamentals. I want you to consider the fundamentals. One of the fastest growing populations in all of Ontario. Now, one of the cool things about Whitby is we are working hard, but it's impossible to keep up, to try to keep up with that population boom. Whitby is committed to building 18,000 new homes by 2031. Anyone see a problem with those numbers? You remember the last slide numbers? How many people do we expect the population to grow by? What? 190 to 193,000. Let's call it 190,000. 190,000 people cannot live in 18,000 homes. That would be a little weird. That would be tough, wouldn't it? Jeez. So now what's crazy is this is being paraded and celebrated as some sort of construction boom. This is amazing. This is incredible. So at surface level, Whitby's overbuilding. We're building too many homes. Madison's here, Minto's home, Treasure Hill's here, Zancor is here. Everybody's here. Sorbera Group is here now. Everybody's here. It's still not enough. Bring the Field Gates. Bring the Greybrooks. Bring them. Bring the Great Golfs. Bring them. We need them. Because we're not going to be able to satisfy that demand. And this is Whitby as a whole. This is not just Brooklyn. This is Whitby as a whole. So there's a lot of development happening right now in Oshawa. Greywood is down in Oshawa. Minto's there. So let's talk about the opportunity. Let's talk about some specifics. Brooklyn specifically, where most of you I think are from here. I don't know if this is a positive for you or negative for you, but the current population is 23,000. Projected by 2031 is 43,000, sorry. So almost double in 6 years. Almost double. You know what's going on with the widening over here of the roads, diverting the trucks. There's a lot of things happening. New community center, hospitals coming in 10 years, probably. But a doubling of the population, going back to the classic fundamentals of economics, supply and demand, twice as many people, but not nearly twice as many homes. Prices have to go up. It's pretty simple. And again, I wrote at the bottom, consider the buyer profile, because the buyer profile for Brooklyn specifically wants what we're building, for the most part. Not all of it. Not necessarily the stacked townhomes, maybe from an entry-level perspective. But they want what we're building. They want that family entry-level project, which really hasn't existed in Brooklyn yet. That entry-level product isn't here yet with the prices of today. Maybe at some point further from the core, maybe. Fundamentals we look at in a healthy market, in a good market, whether it's Brooklyn or whatever you're looking at in your future endeavors in real estate, these are the considerations you want to make. Number one is job growth. Is it there? Is it prevalent? Does it exist in that particular community, micro community? Not Canadian job growth, not Ontario house growth, not even Toronto job growth, but Brooklyn job growth. Is it there? Yes, it is. Income growth. Brooklyn's got one of the highest average incomes in all of Durham. Pretty significant. We can afford our debt. Population growth, is it there? Yep, we just covered that. Existing infrastructure, do we have it? Oh yeah, 407 extension. Pretty cool. Future infrastructure investment, is it coming? Oh yeah, we talked about it. The hospital, the community center, it's coming. Stable economic and political environment, we've got it. It's here. Post-secondary institutions, they're not right here, but they're close enough. They're close enough. Do we have a diverse economy? Yes, we do. Do we have diverse and talented workforce? Oh yeah. And an insulated market. What do I mean by an insulated market? What I mean is an inability to add more. The green belt is very relevant here. We can't just build and sprawl and continue to go outward. There's considerations to be made, like your commute time to that concentric nucleus, or even if you're working in a Markham district or even Stouffville, wherever you're going. It's only so far you can go to make it make sense. If I work in Toronto every day, I've got to be there 9 to 5. I can't live in Brantford or London, Ontario. It just doesn't make sense. That's why a lot of what we see in the core and periphery of the core is going this way. We still have this opportunity to go this way, which is unique and speaks to that scarcity. Okay? And then obviously the high costs from an economic perspective, the high costs to build new. Not a lot of developers are building anything at all. A lot of the land here in Brooklyn wasn't bought last month during the pandemic. It was held for a while. Fieldgate was in Brooklyn about 20 years ago. They've been here. So they didn't buy the land at today's land prices. That's why they can afford to build and launch projects. It's just, it all makes sense. So how do we choose assets? Well, you want to look for a combination essentially of appreciation and cash flow. My whole thing is you've got to attribute a 51 to 49%, one or the other. It's very difficult to find one that's perfect in both. So if you're looking for cash flow, maybe it's multifamily, an investment, where you've got a tenant paying decent rent and it's a cash flowing asset. Maybe it's a commercial building, medical building, you name it. If it's the appreciation, you're looking at the fundamentals, why and how a property asset value is going to go up and accelerate. Okay? So you've got to decipher for yourself what type of investor you are if you're considering investing, if you're more the appreciation or the cash flow. And obviously it depends on market, depends on goals, timeline. But when you choose an asset, we're going to talk about a pre-construction opportunity that's coming to Brooklyn now. It's in the green bags, which are on the bar. You can grab them after if you're curious about one of the projects that's coming. But I really like pre-construction, especially now. Big reason, I'd say the one big reason why I love pre-con today is because you're buying in I'll call it a crappy market today. It's a crappy market. So the prices are reflective of today's crappy market. But you're not opening that door for 2 to 3 years. Low rise isn't the 7-year example I gave you with the high rise. It's 1.5 to 2.5 years. Low rise, they build quicker because they can. 1.5 to 2.5 years out is when we're going to have lower rates based on fundamentals. We can make those predictions. Obviously, crazy things can happen, but we can make educated guesses. If you go out for a picnic in February in Brooklyn, what are you going to wear? Shorts? No, probably a jacket because I can predict in February it'll be cold. Same idea. So based on that knowledge that we're in a market that is poised and positioned to do better, accelerate for growth, accelerate from an investment perspective, better profiles with more money, better jobs, wanting to be here, where population outpaces supply, we can be pretty confident that over the next 2 years, prices will rise. Now, in the meantime, do I want to deal with tenants? Maybe not. In the meantime, do I want to deal with volatility in rates? Maybe not. In the meantime, do I want to deal with deploying a ton of capital? Probably not. That's why I'm more inclined in today's marketplace to consider pre-construction. Intentional uniqueness I wrote down, contributing to decision making. Not all assets are the same. When the market was crazy in Toronto, you know what developers built? The same thing. They built square boxes all the way up, no consideration for architecture, no consideration for amenities, no consideration for the end user or the resale market. Why? Because they didn't have to. Why am I going to spend more when I don't have to? I'm going to sell the building out in 3 weeks. Why am I going to put in a pool? Why am I going to spend money on a famous architect? What are we seeing now downtown and everywhere else? We're seeing a big investment in unique architecture. World-renowned architects. Incredible Soho-inspired amenities. Why? Because they've got to compete for your attention. They've got to compete for the buyers. And it's the exact same thing in low-rise. The product of today is significantly better than the product of yesterday. Significantly. Not just from a building efficiencies perspective, not just from an environmentally conscious perspective or efficiency perspective, but from a design perspective. With all the options, Madison's, Anchor, Treasure Hill, with all the options here in Brooklyn, they're all competing with one another for the limited buyers there are today. Because of that, they're pushing the limits of what they can do in design, in finishes, in lot size, why am I drawing a blank? Bless you. The facade, the look of the space, right? The elevation, it's called. Reversion market, you got to think of the exit strategy. Of course, it makes sense from a pre-con perspective based on what I spoke about. Functionality and design, I spoke about. Tenant pool, qualified and diverse, we have it here. And a big part of the tenant pool here, they work in Whitby or they work in Oshawa. They're not all commuting to Toronto. They're local. They're okay to make that commute. Pricing has to be accepted by the market. Pre-construction pricing today, as of now, a lot of times is cheaper than the resale market. That has never once been a thing in this market. Not once have you been able to buy a new asset, a pre-construction asset, cheaper than you can buy a resale asset. Not once. But now, today, that's the case. Why? Because the developers bought their land for way cheaper than they could have today. They've held it for a while. There's efficiencies in building, and they want to get it off the books in this market. They want the equity, they want the sales to deploy, shovels in the ground, and build. It's wild. Existing plus future growth, always looking at that. We have infrastructure, we have a market, we have an economy. You're not buying, anyone heard of the Orbit in Innisfil? Anyone heard of that funky project? If you haven't, look it up, it's quite interesting. But Innisfil has this futuristic plan to create this orbit, like this futuristic city. But there's nothing in Innisfil right now. So I've had clients call me, Ty, I'm all excited about the Orbit in Innisfil. Can I invest there? Number one, nothing's guaranteed. Number two, it's 20 years out. Number three, like, what the heck? No, it's a bad idea. There's nothing there today. Only thinking about the potential of the future. We need something today, which we have, but we also need something to come. The alternative would be buying in, Liberty Village. There's nothing coming to Liberty Village, downtown Toronto. It is what it is. There's nothing new coming. So you buy there, you're going to benefit from what? The market only. You will be average in terms of your return. Our job is to try to amplify returns. So we dig deeper and consider all angles. Community identity, you all know we have that, and limited ability to add new, immediately comparable supply based on time it takes to build and limited availability of land and land cost and borrowing cost. There's not any new projects launching now that are not yet known of now, if that makes sense. Anything that's coming is announced because no one would dare buy land to build now at these prices. You just can't compete. So it checks a lot of boxes for me. Brooklyn. Pre-con specifically, predictability in payments. You know exactly when your payment is going to be drawn from your account, essentially. There's predictability in when those payments are coming. Hands off, no tenants, no nothing. Easy peasy. Capital appreciation and leverage. So you're appreciating with the market when we consider fundamentals, and then you've got leverage in the equity buildup. Obviously, customization, selection. You can choose the additions you want to make to either amplify value or for an end user or to rent a basement. Lower maintenance and repair costs because it's new. Everything's new. You buy an older asset. Oh, shoot, my home inspector was drunk that day. He didn't check the roof as well as he should have. I can't believe I got to spend 20 grand on a roof next week. Shoot. Oh, my weeping tiles are gone. I got to waterproof the basement. 9 months of lost rent, and I got to redo my basement, which you didn't account for, and it's a loss into your equity buildup. And obviously, latest and greatest innovation. What was the first car you ever had, Doug? First car you ever owned?
Fargo van.
A Fargo van. I don't even know what that is, but a Fargo van.
Yep. 66. 86.
I'm pretty sure my sister's Tesla is a lot different than your Fargo van, yeah?
Oh, hell.
That's probably because it was 100 years ago.
It was a 3 on the tree.
3 on the tree, Fargo van.
How many people in this room can drive that?
My point is, things change. Innovation changes the car you drive today. Your first car compared to the car you drive today. It didn't have a GPS built in. You couldn't speak to it. Hey, Siri, you can do that, right? Even your phone in your hand. You used to have to like type 4 times to get to letter P, right? Now, you just speak to it. Easy peasy, lemon squeezy, easy. So what I say when I say the latest and greatest innovation is you've got the newest technology in all things. Countertops, efficiency, ecosystems, whatever, you name it. All right? Thanks, Ashley. So anyway, our top pick for Brooklyn right now, our top pick is West Brooklyn. I know it's convoluted out there, all the signs, all the stuff, all the things going on. Our team's top pick, with all of this in mind and the way we analyze assets, is West Brooklyn. Okay, it's a combination. It's actually 3 brothers: Centurion Homes, Zancor Homes, and Fernbrook Homes. Those are all names you should know. That's like saying BMW, Mercedes, and Lexus have got together. It's absolutely stunning. It's coming to Ashburn and Highway 7. You probably know the site. Occupancy for Phase 1, and mind you, this is an 8-year undertaking. They're building 800 homes on this site. I love it because master planned gets thrown around a lot. This is master planned. This is a masterful plan. It's a walking community. There's sidewalks everywhere. There's going to be routes right into town. There's going to be easy access, not from the main road, from the side roads, to get into the community. Very family friendly. They're very intentional with the designs of the homes. It's not going to look like you're in some Dr. Seuss movie where everything looks the same. Okay, they're going to be unique in their build, their structure, and their facade, elevation. The pricing is just, I don't know how they're doing it at this price. It's only because they got the land cheaper than they should. But the towns are $799 freehold. Okay, that's crazy. That's what the resale towns are going for now. Semis, $860. 32-foot singles starting at 1.1. Detached home. Resales 1.2 today. And 38-foot singles, so just a wider lot, bigger homes, 1.3 and up. Pricing makes a lot of sense. The site itself makes a lot of sense. The location itself makes a lot of sense. And the development team is AAA. So when I take my investment lens and overlay it to West Brooklyn, very rarely do I find something that checks a lot of boxes. I've got about 10 would love to haves, if you will. Generally, if I hit 7 of them, it's a go for my clients. I say, yeah, you have my blessing. They can do what they want, but you have my blessing. This one's got 10 out of 10. And very rarely do I come across a 10 out of 10. It's got the timeline that I like. It's got the market timing that I like. It's got the AAA developers that I like. It's got the location that I like. It's got the suite mix that I like. Suite mix, I say for condos, but asset mix that I like. Combination of towns, semis, and detached. I'll tell you more about it. I actually bought here myself. I bought 2 for myself for an investment. Townhomes, the elevations are stunning. You've got rear lane townhomes. These are the rear lane I don't love. I don't love rear lane townhomes in this development. I like the front entry with the garage. A little more conventional, a little more attractive for the end user, and the change in price, it's a much better play. But basically, the deposits for these is another big thing. So I'll speak to it briefly. But the deposits on the townhomes, it's $15,000 with your offer, $75,000 total for the next 2 years. $75,000 you're putting down on these total until you close in 2 years from now. Spread out over the next 365 days. So in 90 days, another $15,000. 180 days, another $15,000. 270 days, another $15,000. And a year from now, another $15,000. For a total of $75,000 locked up for 2 years, over the course of a year, 2 years total. Letting the market do its thing. This is the appreciation play. When it's done, the rental profile's there. You get the appraisal, you register your mortgage, you decide what you want to do. Move in, downsize, move your kids in, rent it out. The numbers make sense on the front entry towns, not the rear lane. Don't like those. Sorry, Zancor. The semis. You don't see this. You don't see the attention to detail in the semis. Price points are incredible. The size of these things, we've got all the details for you there. We'll give you green packages after. It's got floor plans and everything you could possibly need. But the semis, like if I didn't tell you that was a semi at first glance, you wouldn't know. Other than if you really look at the 2 doors, sure. But the elevation, the peaks, the way they've designed them, it doesn't look like some weird, ugly building or the 2 of the same thing. Costs more to do that. Why are they doing that? Because they're competing with the other developers. They have to, for attention. This is a generational opportunity to get into anything like this because this won't always be a thing. These semis are bigger than some detached in this pocket, in this area. And at that price point, you're still getting your 3 or 4 bedrooms, your 3 or 4 bathrooms, you're getting your garage, you're getting your backyard, you're getting all the things you'd get in a detached for $300,000 less. These are one of my favorite plays from an investment perspective. The semis are sensational, and it's $90,000 total on the semis deposit, no matter what price point you get to or elevation you choose.
How many square feet are
They range from 1,600 to 2,400. Detached, so these are the 32-foot singles. This is what I bought, both. I love the 32-foot singles. The 38, there's going to be less of them, so to that scarcity point, less of them. But my lens, my investment lens, you get the same things. You get the same things. A little smaller, maybe smaller 4 bedrooms, but you get 4 bedrooms. Maybe it's not still 4 bedroom, bigger 4 bedrooms than the 38-footers. Maybe it's a little more width, but what does that width get me? It's not like on a 38-foot I can get a swimming pool that I can't get in a 32. I'm not getting anything more. When I talk about condos, and we do a lot of stuff in Toronto, people paying a floor premium, a lot of times there's a floor premium from a developer, right? Every floor is $1,000 more. Why would you pay a floor premium if it doesn't actually change your view? If I'm going from the 15th to the 17th floor and it doesn't change my view, I'm still blocked by another building, why am I paying $2,000 more for that? It doesn't make sense. If I'm going from the 15th to the 30th floor and I clear that building in front of me for a clear view of the CN Tower or the lake, sure, it's worth it. My point with this project from a 32 to a 38, there's no reason to make that jump, from my opinion. And again, this is just the way we analyze property, because it's a similar buyer profile. It's just not nearly as much money. There's only a few 38s that back onto the ravine. There, I would consider spending more. Cool thing about this project, no premiums for lots. So because we're still in phase one, there is 0 premium for priority lots. So one of the interior, for example, one of the interior 38s is the same price as one of the ravine 38s. This is the opportunity in this market. In any other market, you're paying a $50,000 premium for a ravine lot, maybe more. In this market today, no premium in this phase 1 of 8 over an 8-year span. This is phase 1. Okay, so just a little sample for you. Why West Brooklyn? Why do we like this compared to what else is available in the market? Connectivity and education. There is a proposal for a school on site in the community, right there. Walkable, drivable, bikeable. It's very community. They're building a whole ecosystem right there. There's going to be a park and a playground and a school. Phenomenal. Housing demand and market opportunity. So obviously where it is, all the other projects are same place where it is, but being at that end of town, more suburbia and immediate access to highway, just gives it a little nudge. The developers, I've worked with Zancor for a while. I know those guys really, really, really well. And then obviously the brothers, Centurion and Fernbrook, they're household names for the most part. They build a quality project with the end user in mind. It's not necessarily where we cut corners, where we can build what is going to save us money, but what's the end user going to appreciate more. And it's seen in their designs. Like there's other developers in the pocket, you look at their design, why would they do that? Why would they make that room that way? It doesn't make sense. And yes, you have customization, you can try to tweak it, but sometimes you can't because you cut corners with architecture and design and supporting walls and this and that, and you can't move things around. These guys, it's flow. It's beautiful. Price advantage, they're the best price project as well, and the design of the actual finishes are quite sensational. Site plan is in your package. I won't speak to it, but this is basically the overall site plan, bird's eye view of phase 1. There will be more phases. Not everything you see there on your sheets is available now. They're not selling everything now. They sell in phases. Generally, as phases go on, prices go up. They charge more, they sell out, prices go up, and obviously the way the market's going, prices will go up. But you can kind of get a feel of where the townhomes are situated, singles, detached, and whatnot. Good pre-com project. I'll let you kind of look at this on your own. These are what we look at. West Brooklyn, I told you, checks my boxes. I like it. And that's kind of it. That's what I got for you. So if you want information on that specific project, there's green bags there. I'll take questions, but if there's not any, we can have a drink and eat some food, and you can ask me stuff as we go. But if there's any questions that you have now, happy to take them. On the market overall, or what's going on, the project. I answered them all already? Cool. All right, well, thanks. Yes?
Have they been released yet?
Phase 1 is released. Yes, phase 1 is released. Month ago. a month ago. They're doing good. They're selling at a pretty good clip. So, yeah.
Has the HST impacted?
The HST rebate? So
Yeah.
first-time buyers, $50,000 HST rebate on pre-construction only. It's not yet signed off on. So we'll see what comes out in the budget, November 4th, federal budget. Everyone's talking about it. All the developers are talking about it like it's already implemented. It's not implemented yet. It's not a guarantee. When it's official, we can talk about it for a first-time buyer, but it's still not official. But ultimately, yes, this would apply for that. $50,000 first-time home buyers are eligible for $50,000 GST credit on pre-construction, only pre-construction. The budget now, I was just meeting with a guy who used to be the right hand to Justin Trudeau, economic council or something, his name is. His name is also Tyler. Anyway, I was speaking to him and he said that a lot of their proposals might come out in the budget, and one of their proposals was $50,000 GST rebate across the board, so not only for first-time buyers.
Yeah, because I thought they removed it.
But it's
Like,
eligible.
Were they talking about that, or did I imagine that?
They never talked about removing it, but you might have heard someone say, which no one's saying, that it's not official yet.
Yeah.
So everyone's talking about it like it's already a thing, but it's not yet.
Yeah.
It's
okay.
as
I'm
good as.
spreading them- I'm spreading them.
Yeah.
I'm one of those ones who's like, this is happening, yeah.
It's like 90% going to happen, but there's always a chance, and you don't want to buy it with the intention that it's for sure going to be a thing when it's not officially implemented
Right.
yet. But I can email you stuff on it specifically if you want. There's some good resources on it, but still it's a little ambiguous because it's not officially written. So anything could happen. They could say it's not 50,000, it's 25,000. They could say we'll jump to 75. They could say it's not happening. They could say you have to be a single first-time buyer. So yeah. But all the developers and a lot of agents are talking about it like, oh, first-time buyers, yeah, $50,000 GST credit, yeah, 50,000 off. It's not. It's not official, but likely.
Okay, cool.
Yeah. Good question.
What's your thoughts on the condo market in Brooklyn, Whitby, with all the new ones in the, down by the harbor?
Hate them, don't like them at all. I think that there's a reversal in trend of what makes a good investment. To live, they're great. To live, they're great. To live, they're great. I like them. They're decent builders, quality builders. I just have my investment hat on right now. But from an investment perspective, I don't like them because there's not necessarily a need in those pockets for them yet. They've overbuilt them a little bit, per my previous point about highest and best use. You build something the community market doesn't need in a crazy COVID market, someone's going to buy it. But when you build something that marketplace doesn't need today in a market like this, when they realize they don't need it, it's not effective. The tenant profile's not there. It's just not there. The rents you're getting compared to the asset prices that they were initially sold at isn't there. The future of them is fine, but it's going to be a long-term play. And then they're only going to get older when it's time for them and the new guys come in, then you're competing with the newer product and you're the older product. So that's my short version, but I'm happy to talk about it more. Quality projects, good stuff. I don't know if you've bought there, if you're thinking about buying there, I don't know your position, but my unbiased opinion is, from an investment perspective, no. Yeah.
Like Station 3 and Whitby is hot.
Yeah.
Well, they're selling them. They're not hot, sorry. They're just selling them for like a really reduced price, which is.
Because they have to, because no one's buying them, because they don't exist, and the developers already built them, and they're already done, and they have to get them off their books because they're carrying the debt. So there's an opportunity there, but even so, buying a good asset at a great price is never going to be as good as buying a great asset at a good price. So I would rather spend more in a market like this where the fundamentals make sense on what I know is good, rather than saying, they were selling this condo for $600,000 at launch, now the builder's selling it for $450,000. Well, I'll tell you what, everyone that bought there originally can't get financing. Builder's going to get inventory back. They're going to have to do a blanket finance, a blanket mortgage on the building. Developer's not going to like that. It's not going to close for a while. They'll extend occupancy, so you're paying phantom fees way longer. Now you bought in at $450,000, great, but that's the new precedent. Good luck selling it on the resale market for the next 3 years, and even in 3 years, it'll probably maintain at that price because there's no reason to be there. And I could be wrong, but from a high-level fundamental perspective, that asset in that pocket isn't going to be accepted in the market going forward. Yeah. There's not a need for it. There's always a need for it. There's always someone. There's always kids moving out of mom and dad's house that want to live close to mom and dad, and they still, I don't know, they're still going to commute to U of T or go to Ryerson or be downtown most of the time. And based on the prices downtown right now compared to Whitby, it's just a silly trade-off. Like I could buy in Whitby for the same price as Toronto almost now. So that concentric city model, well, it just doesn't make sense. It's more the fundamental reasoning or the personal bias of I want to invest where I live or what I'm familiar with, which isn't intelligent from a black and white perspective, like a fundamentally investor perspective. But we're all guilty of that. Like, I live here, so I want to invest here. In this particular case, you live here, it makes sense to invest here, but not always. So that's my take on that, very honestly. Yeah. Not bad projects, good build, good project. They got screwed with timing, but I wouldn't invest in it now. I wouldn't invest. Condos in the core all day long. Hardcore core Toronto investment or nodes, other nodes. Oshawa and Hamilton, maybe certain pockets, more so Hamilton. Toronto number 1, Hamilton number 2 will always be my nodes. Like Hamilton, people don't even know. It's one of the biggest cities in Canada, and it's just scratching the surface. Hamilton's going to be nuts. But from a condo perspective there, in markets like this, in Whitby, where you can, same thing, like across the street, you can get a townhome for $750. So that, it just doesn't make sense. It's like saying I could buy a Civic for 30 grand or a Ferrari for 40. It's just easier to justify that next jump, especially when you consider the profile. So I hope that makes sense. But that's my take. Again, don't know your position. Sorry, depending on if you bought or whatever. But yeah, that's the honest take.
We've seen a lot of condos being built, obviously, in the last few years. And
Oh, yeah.
the master plan is a ton coming more. Seam and Oshawa, obviously.
Density, that's the whole density play.
Yeah, you're starting to see some in the last couple of years.
And because of that timeline, Whitby, Oshawa is going to be a little shorter than Toronto. Still, you're looking 6 years start to finish. A little shorter than Toronto. But a lot of those launched and sold and started when the market was crazy. So now we're seeing the inventory come to market in a much different landscape, but there's nothing new coming. A lot of proposed because we want density, but the developers aren't going to put shovels in the ground if they can't get to their 80% sold financing, which they will not get to. They won't. So, yeah.
So it would be fair to say that buying pre-con here now, holding on to your current investment or property that you have, gaining more equity throughout the build, you're gonna buy low and sell higher.
Yeah, that was kind of the thing, like for a lot of people that have been buying this project are upsizers. So it gives you the opportunity to basically do that, buy low, sell high, which is very difficult to do in any market, but this is a market to do it with this project. Because to your point, you don't need to sell now. A lot of these upsizers that we're speaking to in Pickering, Ajax, Whitby, whatever, the upsizers that are moving up to Brooklyn, they can afford to put $75,000, $90,000, $130,000 down over the course of a year, even pulling equity from their principal residence, but it's not the best market to sell in. So don't sell yet. Hang on. Wait until this is done in 2027, and then you can move in and sell your home in a better market. So you're appreciating here and there. And then you don't have to replace your furnace. You don't need to renovate your kitchen. You don't need to finish your basement. You don't need to replace your roof. It's all new. So that's one of the trends we're seeing, yes. So we're seeing two very specific profiles. Well, first-time buyers and upsizers and investors. That's the profile that's buying in Brooklyn as a whole, but specifically our clients. Cool.
Thank you.
Hope you learned something. Thank you. Thank you. We have more drink tickets. We have more drink tickets if you want them, and there's food, so help yourself, hang out. We'll be here. Thanks, guys. If you want one of those green ones, they're over there.